Hi, I'm Drew Millard. I'm a portfolio manager at Frame Global Asset Management, and I'll be speaking about the final step in our portfolio management process, optimization. Once we have our inputs of bootstrapped distribution returns and correlations between asset classes, the final step of the portfolio creation process is optimization. Optimization brings together all the parts of our portfolio management, our economic outlook, historical data, and correlations, and uses this information in combination with portfolio goals and constraints to create 4 distinct models of increasing expected return and risk tolerance. Optimization is a crucial step for Frame Global because the software we use, Palisade Decision Tools Suite, is able to analyze each asset class in combination with one another and consider a vast number of potential portfolios made up of the various asset classes immeasurably faster than we could ourselves. We need to be able to examine as many potential, valid portfolios as possible. We're able to combine the analysis Palisade does for us with our own research on the economy, macro views, and the markets to best create portfolios that reflect both quantitative discipline and real-time macroeconomic opinion. As one would expect, asset classes behave very differently depending on the macroeconomic environment we're currently in. Because of this, when we use expected return, downside risk, and correlation data tagged from a particular historical environment in the optimization process, the result is very different than if we use data from a different historical environment, i.e. if we used all growth data versus all recession data. Optimization thus creates final portfolios that are specifically tailored to our customized 12-month economic outlook. With the historic behavior of all asset class inputs considered, our models are optimized to produce the highest expected return given downside risk tolerances designed to meet a range of investor goals. Our conservative model is constrained for a 5% or less chance of having negative returns. Our moderate growth model is constrained with a 10% chance, our growth model with a 15% chance, and finally our aggressive growth model with a 20% chance or less of having negative returns. The expected return for each model follows the same logical pattern. As the downside risk for the models increases through the group, we optimize such that the expected return for the portfolio increases as well. Thus, with a greater chance of a loss comes the expectation for a greater return. The investor can decide which of the 4 levels of risk-return profile best meets their goals. Both pieces are of utmost importance in portfolio construction. We strive to avoid losing money for our clients, while at the same time selecting the best asset classes to be in order to provide for highest expected return. Because we use such a robust and intricate software program as Palisades, we've discovered something very interesting about incorporating the correlations between asset classes into the portfolio optimization process. If we were to simply weight various asset classes to create a portfolio to sum to 100% and note the weighted downside risk, we would observe an overall portfolio downside risk number. However, when we also include correlations of asset classes in the optimization process, the downside risk of the optimized portfolio is actually less than if we simply weighted each constituent's downside risk. At a high level, this is because correlations provide further diversification benefits on top of simply including a sufficient number of varied asset classes in the portfolio to begin with. We derive the most diversification benefit from not only the members of a portfolio, but how pairs of those asset classes work with one another to offset losses and mitigate downside risk even further. This is how we look more broadly at everything diversification entails to make the Frame Global approach as thorough, flexible, and differentiated from other managers as possible. The final step of our process is to select ETFs that best represent the various asset classes and underlying indexes that make up our portfolio in a given month. These ETFs need to have minimal tracking error and therefore maximum reflection of the asset class, so our portfolios can represent asset class behavior in the markets as efficiently as possible. Thank you very much for viewing our presentation on optimization. To learn more, please visit our website at frameglobal.com, or for further questions, do not hesitate to contact me directly.